Hi, I'm Keith McCullough. Welcome back to Tweet Keith. This is where you ask me questions on Twitter, and I effectively pick the top 3 questions that are relevant to right here and now in today's market day. So what we did was we picked 2 macro questions and 1 stock. Let's get into the macro question first. First question is from Aleem Abdullah, which is, do flows supersede fundamentals with respect to U.S. equity markets? Now, Aleem, I think it's a very interesting question because we often go back and forth with our institutional customers on this very question. What's more important, the growth style factor that was the U.S. stock market in 2013 and parts of this year, I might add? There's plenty of growth that's associated with today's rally. Don't forget, dollar up, rates up, stocks up. That's what we like. That's a growth signal. On the other side of that, we've had some growth data starting to slow. But on the other side of that, of course, you have fund flows, which have been really instrumental in driving this equity market higher. So just think about it in terms of bond outflows. The peak in bond inflows was only in 2013. So in 2013, the average weekly inflow to the bond market was about $5.8 billion a week. That's a lot of flow. Last year, really, you just started the outflow. An average weekly outflow of just inside of $2 billion a week. I mean, just to get to back to where we were, put it this way, in the other bond market drawdowns, you would have to double the nominal dollars coming out of the bond market. In other words, assets under management in bonds could double from here in terms of the outflow, and that's a really big problem. So I think that will be ongoing. It is potentially secular if, in fact, rates have hit an all-time low. So again, just keep that in mind as you think through that question. Very complex question, not an easy one to answer. Second one, this is easier. From SG Imperium FX, what will need to happen for you to short the S&P 500? Now, if you ask me what duration, that's easy. On an immediate term trade duration, I could short the S&P 500 intraday, and that might be, today might be the call to make. But the reality is, to make this kind of call that people in the popular press and the punditry like to make, trying to call the top in the S&P 500, to be clear, that's not a process. That is just trying to get attention. So we're not trying to do that. What I would do is I look for the signals. So let's take the immediate term first. I'd need an immediate term trade over bot signal number 1, which would have to get me above the S&P 500 of, like, today, 1855. But that number changes every day, so I may not do that tomorrow. The second point would be, on a trend basis, I'd have to see the confluence of growth slowing supersede fund flows being bullish for equities. Now, that's not a given. Not here. So again, that would be another thing. And then the third thing would be the S&P 500 would have to break my intermediate term trend line, different duration, support of 1771. As most people know, I've actually made more short calls over the course of building Hedgeye than long calls, so I'm not afraid to short the S&P 500. It would have just simply been the wrong call to make for what, about a year now? So I'm in no rush to do that, particularly today as the market makes higher highs. Now, the final question is on a stock. And this question is from, I'm not sure what his real name is because some people who like to poke at me like to do it without their real name, which is fine. Nick Gecko, I think that's a redux of Gordon Gecko. Question is, when are you stopping yourself out of RH, which is, of course, Restoration Hardware? Now, Nick, seriously, man, I'm not stopping myself out of my only loser today just because it's a loser. I have a thesis on this. Now, if you rewind the tapes on this, has been in our Investing Ideas product since last year. The stock was a double last year. And what happens when we have a stock that's down on a day like today is not fear our own shadow. No. We have a research team. So what I did is I walked over to Brian McGough, and he gave me 5 reasons. Brian McGough, of course, is the bull on Restoration Hardware, in as much as he was the bull last year on things like Wolverine Worldwide and Nike. Very good analyst. And he gave me 5 very good reasons, Nick, why I wouldn't stop myself out of my own shadow. Which would, of course, be square footage growth could triple. That's a lot. Sales per square foot can go up from $1,000 to $1,600 a foot, which is another a lot. RH Direct, which is Restoration Hardware's online business, could be up a 2 to 3 bagger from here, which is a lot. Revenues could go over $5 billion over the 3 to 5 years that is our investment case on RH. So going from $1.5 billion in revenues to $5 billion in revenues. And McGough thinks that over time, the company has earnings power of $10 a share. Nick, stock's at 60. Again, you don't have to use your real name to know that 60 divided by 10 is a pretty low number. So with that, I'll leave you with that. And if you have any other questions, please tweet me at Keith McCullough, of course, is my Twitter handle.